Welcome to the deep dive. Today, we're really ripping open some fascinating source material. It's a detailed stock analysis report focused purely on Nvidia, ticker NVDA.
And this one's dated June 12th, 2025, so it puts us right in the middle of all the buzz about NVIDIA and AI.
Exactly. So our mission today is pretty clear. Dig into this specific report, pull out the key insights, understand its arguments.
And basically get you up to speed quickly on how this analysis sees the investment case for NVIDIA stock.
We're cutting straight to the core of this one perspective: the business, the money, the competition, the risks, all based on their data as of mid-2025. Let's jump in.
Absolutely, let's do it.
Okay, so for years, NVIDIA meant one thing to most people: gaming, graphics cards, right?
High-end GPUs for PCs, that was the image.
This report, wow, it paints a picture of a transformation that's, well, it's stunning.
Stunning is definitely the word. I mean, this isn't just tweaking the business model. The numbers here show a fundamental rebuild. Look at this. Q2 fiscal 2020, gaming was 51% of revenue.
The majority.
Yeah, the clear majority. And the data center, just 25%.
That feels like ancient history now, just a few years back.
It really does. Okay, fast forward to Q4 fiscal 2025, that's ending January 2025. The report shows data center hitting $35.6 billion
In one quarter.
in one single quarter. And that number alone was about 90.5% of their total revenue for that quarter, which was $39.3 billion.
Fun. So like 5 years, data center goes from a quarter of the business to over 90%.
Yep, that's what the report lays out.
And gaming is down to what, about 6%?
Around 6.4% in that same quarter. It's not a pivot, it's a complete company remake based on these figures.
Okay, so what exactly is in that huge data center segment according to this analysis?
Well, it's the core stuff powering the AI boom. We're talking their top-tier GPUs, the H100, the newer B200 Blackwell chips, the big GB200 systems.
The hardware.
The heavy-duty hardware, exactly. Plus, the high-speed networking that ties it all together, like their InfiniBand and Spectrum Ethernet products. You need that to connect thousands of these GPUs efficiently.
And the report mentioned software too, didn't it? That seemed important.
Oh, absolutely critical. The analysis really emphasizes things like the CUDA programming model, the AI enterprise software suite, and these new NIMS NVIDIA inference microservices.
Oh, okay.
And the point the report makes is these aren't just extras. They build this whole ecosystem, create recurring revenue streams, and make it really, really hard for customers to leave. High switching costs.
So, okay, gaming's still there, ProViz, auto, but this report basically says data center is NVIDIA now.
It's undeniably the engine driving the train, according to this analysis. The main focus, the main revenue source.
Right. So with that kind of financial shift, how does the report describe their standing in the market, especially in AI chips?
It calls it a clear leadership. Unambiguous. The source estimates NVIDIA holds something like an 85 to 90% share of the AI GPU market for both training AI models and running them, inference.
85 to 90%.
Yeah.
That's dominance.
It's a huge lead. Staggering, really.
But a position like that must attract competitors like moths to a flame, right? Who does this report identify as the main challengers?
Well, you've got the usual suspects. AMD, obviously, with their Radeon gaming cards, but also their Instinct MI300X for data centers, often aiming for similar performance, maybe at a lower price point.
Okay, AMD. Who else?
And Intel, the CPU giant trying to make inroads with their Arc GPUs and the Gaudi AI processors.
So direct hardware rivals. But then the report talks about this other dynamic, this co-opetition. That sounds complicated.
Yeah, and this is maybe one of the most interesting tensions the report highlights. NVIDIA's biggest customers, think Google, Amazon, Meta, the hyperscalers.
The ones buying tons of NVIDIA chips.
Exactly. They are also potentially their biggest future competitors.
Wait, how does that work? Their best customers are trying to replace them.
Kind of. These huge tech companies are pouring money into developing their own custom AI chips called ASICs, like Google's TPUs or Amazon's Trainium and Inferentia chips.
Why are they doing that?
Well, a couple of reasons, according to the analysis. To tailor chips perfectly for their own massive, specific workloads, gain more control, and crucially, maybe reduce their long-term dependence on NVIDIA and lower costs.
So NVIDIA's in this weird spot selling billions to companies that are simultaneously trying to design NVIDIA out of their future stack.
Right.
How do they fight that?
The report points straight back to CUDA, that software ecosystem.
The software lock-in.
Precisely. It says developers are so deeply invested in CUDA that moving AI workloads to a competitor's chip AMD, Intel, or even an in-house ASIC isn't trivial. It takes time, money, retraining. It's a huge barrier. That software moat is a massive advantage even if others build good hardware.
Got it. And the report mentions the broader chip industry context too, right? Like
Yeah.
needing lots of capital, fast innovation, and relying on TSMC.
Yeah, it touches on that. NVIDIA designs the chips but doesn't build them the fabless model. They rely heavily on foundries, especially TSMC in Taiwan, for the cutting-edge manufacturing.
That TSMC reliance
Mm.
feels like something we need to remember when we talk about risks later.
Definitely. It's a key dependency, big implications.
Okay, let's switch to the financials. So the report dives deep here, and explosive growth barely seems to cover it.
Oh, the numbers detailed here are just extraordinary. Look at the revenue path. FY23, $26.97 billion. Okay, respectable.
Yeah.
FY24, it jumps to $60.92 billion. That's 126% growth.
Doubled, and then some.
Then FY25, $130.62 billion, another 114% jump year over year. And the trailing 12 months TTM ending April 2025 already hit $148.89 billion.
Doubling revenue 2 years running for a company that size,
Right.
that's almost unheard of. Did profits keep pace?
Absolutely. Net income went from $4.387 billion in FY23 to $29.76 billion in FY24, and then $72.88 billion in FY25.
Yeah.
The TTM figure ending April 25 was $80.64 billion. The report gives EPS to $2.94 for FY25, $3.25 TTM, though it notes stock splits make direct comparisons a bit tricky.
What about the margins? That tells you about pricing power, right?
That's a crucial point in the analysis. Significant margin expansion. JAPT gross margin climbed from 56.9% in FY23 up to 75.0% by FY25.
75% gross margin.
Yeah. It signals they weren't just selling more, they were selling it much more profitably. That strongly suggests intense demand and, frankly, significant pricing power for their top AI chips.
And how do these numbers look compared to competitors, according to the report, the ratios?
They paint a picture of, well, exceptional efficiency. TTM net profit margin over 50%. Compare that to AMD around 8%, or Intel, which had negative margins in FY24 based on the data here.
Over 50% net margin.
In return on equity, ROE, the report highlights a stunning 115.5%, just incredible profit generation from shareholder equity, way, way ahead of competitors like AMD or Intel in this period.
115.5% ROE is...
Yeah, that's almost hard to wrap your head around. Speaks volumes.
It really does stand out. Insolvency, liquidity, also very strong. Low debt to equity, about 0.12. Strong current ratios between 3.39 and 4.44. The analysis basically says they're financially rock solid, not drowning in debt, generating huge amount of cash. These ratios outperform peers significantly.
Okay. Transform business, market dominance, software moat, absolutely stellar financials. Sounds like a slam dunk investment, right?
But this is where the report gets really interesting, isn't it? This is the core complexity, maybe the aha moment, the valuation.
This is exactly where the rubber meets the road in this analysis, yes. Trying to put a fair price on a company growing like this, in a market like this, it's tough. And different methods, as the report shows, give wildly different answers. It's a real confrontation of valuation approaches.
So the report includes a discounted cash flow analysis, a DCF, standard fundamental tool. What did that model suggest, based on their assumptions?
Right. So using the specific assumptions laid out in the report, which they describe as moderately conservative, things like a 12.5% discount rate, the WACC, and only a 3% long-term growth rate forever.
Okay, pretty standard inputs for a mature company eventually.
Exactly. That illustrative DCF model came up with an intrinsic value between roughly $34 and $46 per share.
Whoa, wait. $34 to $46. When the report notes the stock was trading around, what, $140, $150 at the time?
That's correct. A huge gap.
The fundamental value is less than a third of the market price, according to that model. It's jarring.
It is. And the report highlights this directly. It explicitly states this DCF result is significantly below the market price. This is the crux of the valuation puzzle presented. The traditional long-term view looks completely disconnected from the market's current assessment.
So why the massive disconnect? How does the report explain the market paying $140 plus sec? What's the other side of the argument?
Well, that's where relative valuation and the whole market narrative come into play. The market, as described here, isn't just looking at that long-term steady-state DCF future. It's paying a big premium based on the expectation of continued very high growth.
The near-term explosion we just talked about.
Exactly, and it's putting immense value on Nvidia's dominant position right now, the CDA moat, the sheer size of the AI opportunity. The market's betting the future growth will justify today's price.
Okay, so the bet is that earnings will grow so fast, they'll essentially catch up to the high stock price relatively quickly.
That's the idea. And interestingly, while the report says Nvidia trades at premium price to sales and price to book multiples compared to its peers.
Which makes sense given the growth difference.
Right. But it also points out the TTM price to earnings ratio, around 46 back then, was actually lower than Nvidia's own 10-year average PE of about 60.
Huh. So on an earnings basis, it wasn't as expensive as its own history suggested.
Correct, based on trailing earnings.
Yeah.
And the forward PE, looking at estimates for fiscal 26, was even lower, around 33.4, according to the source data.
Okay, that helps explain the market's view. Expensive relative to slower companies, but maybe not unreasonable relative to its own expected earnings growth velocity.
Precisely. The premium is for the speed and scale of anticipated future earnings fueled by AI. So the report takes this whole complex picture, the low DCF, the high market price driven by growth hopes, and synthesizes it into a 12-month fair value range.
And what range did they land on for the next year?
They proposed a range of $110 to $160 per share for that 12-month horizon.
Okay, $110 to $160. So that range kind of bridges the gap, acknowledges the fundamentals, but leans into the near-term growth expectations.
Yeah.
And the market price of $140, $150 was right in there.
Exactly. It tries to balance those fundamental anchors with the market sentiment and the expectation of continued strong execution in the near term. It does note analyst targets are often higher.
It really underscores the challenge, doesn't it? Valuing these transformative companies where the future looks so different from the past.
It absolutely does. Standard models struggle. You have to weigh fundamentals against momentum and massive market shifts.
All right, strengths, financials, the valuation puzzle. Let's flip the coin. What are the big risks? What could derail this train, according to the report?
The analysis doesn't pull punches here. It lists some major risks. Intense competition is high on the list. We mentioned AMD and Intel.
Right.
But the report really emphasizes the threat from those hyperscalers developing their own chips.
That co-opetition again. The big customers potentially becoming big competitors.
It's a constant dynamic. Then, critically, geopolitical and regulatory risk. The report is specific about U.S. export controls hitting sales to China.
Is that theoretical or?
No, it gives a concrete example. Licensing needed for the H20 chips designed for China. And it cites NVIDIA's own Q2 FY26 outlook mentioning a potential $8 billion loss in H20 revenue because of it.
$8 billion. So that's a direct, quantified hit from geopolitics already baked into their forecast.
Because that's what the report states, yes. A tangible impact. Then there's supply chain risk.
The TSMC reliance we mentioned earlier.
Exactly. Heavy dependence on just a few foundries, mainly TSMC in Taiwan. That means risk from capacity shortages and, the whole geopolitical situation around Taiwan. Any disruption there is a big problem.
Huge problem for supply. What
Plus, execution risk. NVIDIA has this ambitious roadmap, Blackwell, Rubin, Feynman platforms coming. Delivering those complex products on schedule without hitches is crucial but very challenging.
Can't afford delays or stumbles.
Not when competition is chasing you. Customer concentration is also listed. A few hyperscalers account for a huge chunk of revenue. If one or two pull back significantly, maybe because their own chips are ready, that would hurt.
Makes sense.
The report also mentions the stock's high beta, around 1.7 to 2.0, meaning it's likely to be more volatile than the overall market. And finally, the possibility that over time, increased competition could start to chip away at those fantastic margins. Pricing power might not last forever.
So a compelling growth story, but definitely walking a tightrope with some significant real-world risks.
It's a balanced view. You have to see both sides. Understanding the potential headwinds is crucial.
Okay, so let's bring it all home. What's the report's final take? The outlook, the recommendation?
Well, the outlook section points to several potential growth drivers still ahead. Just continued strong demand for AI compute power, the successful rollout of Blackwell and future platforms.
Keeping the product cycle going.
Right. Expansion into new areas, automotive, healthcare, robotics, growth from AI PCs, edge AI, and importantly, getting more money from software and services, like those NIMs.
So still multiple growth levers to pull, assuming execution and market demand hold up.
That's the view presented. So the final conclusion boils down to Nvidia is the clear AI leader, strong moat, fantastic execution, but it faces real risks and carries a premium valuation.
And after weighing all that, the complexity, the risks, the potential, what's the bottom line? The actual recommendation from this June 2025 report.
The report explicitly lands on a BUY recommendation, specifically with a 12-month time horizon.
A BUY.
Yeah.
Interesting. Even with that huge DCF gap we discussed earlier, how do they justify that?
The justification laid out in the report rests on a few key pillars: their unmatched leadership position and that powerful ecosystem. The expectation that strong growth momentum continues, even if the rate of growth might slow down from those crazy triple-digit surges.
Okay.
Proven management execution, big confidence in Jensen Huang and the team, and ultimately, the belief that earnings can grow fast enough over the next 12 months to help the stock grow into its valuation.
Assuming things go smoothly.
Right. It's a BUY recommendation made with eyes wide open to the risks and the likely volatility.
Okay, that really crystallizes the perspective in this particular analysis. You've got this company that reinvented itself, dominates a booming critical market, has this software lock-in, and is posting just incredible financial numbers.
But yeah, at the same time, you've got a stock price that looks way out of line with traditional fundamental value metrics, faces serious competition, including from its own best customers, is dealing with tangible geopolitical hits to revenue right now, and depends heavily on a potentially vulnerable supply chain.
It really is the epitome of a high-growth, high-stakes investment dilemma, isn't it? Does the future potential outweigh the current premium and the very real risks? This report from mid-2025 argued that, for the next year at least, the momentum and leadership did justify a BUY, while being very clear about the challenges.
And that leaves a provocative thought for you, the listener, to chew on based on this analysis. Can Nvidia keep innovating fast enough? And can that full stack strategy keep them far enough ahead of everyone, including Google, Amazon, Meta, while also navigating these tricky geopolitical waters, especially around China and Taiwan? And maybe even more fundamentally, how will the AI market itself evolve? And what does that mean for demand beyond just the next 12 months?
That's the multi-billion-dollar question, isn't it? And hopefully this deep dive into one specific analysis helps you frame your own thinking.
Yeah, we hope unpacking this source helps clarify the complex picture around NVIDIA as seen at that point in time.
If this kind of deep dive is valuable to you, getting these complex topics distilled and analyzed, well, make sure you subscribe. That way you get the fastest, most frequent updates from our future explorations.
Definitely subscribe. And thanks for joining us on the Deep Dive.